Hello and welcome. I'm Matt Staninger, and I'm going to be your host today. I am joined by Steve Blake. Steve is Senior Managing Director of Evans May Advisory, and we are going to be talking about the latest tax bill that was recently signed into law by President Trump. We will give a brief summary of the bill, new and existing provisions, how it could impact the franchise industry, and more. Steve, thank you for being here today.
Thank you, Matt. I appreciate you guys having me.
To start off, can you give us a general overview of tax changes applicable to our lines of business?
Yeah, so this latest tax bill that was signed into law by the president on July 4th is fairly comprehensive. I don't know if anybody remembers when Trump was president the first time we passed the Tax Cuts and Jobs Act, the TCJA, and it was the biggest change in tax code since the tax code change of 1986. So it had been decades since we'd had such a major tax bill, and now we've got another one here to start Trump's second presidency. You know, the bill's of roughly 870 pages. The executive summary is about 56 pages, so there are a lot of provisions. And a lot of what it's doing is trying to extend or make permanent provisions from that Tax Cuts and Jobs Act of 2017. So a lot of those provisions were either in the process of expiring or were about to expire. So most of what this bill does is simply extend those provisions and allow us to have those tax benefits going forward.
Great summary. Let's talk a little bit about those extensions. What has stayed exactly the same or is very, very similar but being extended in a modified way?
Yeah, so there are a number of provisions that are being either extended or made permanent. So to give you some examples, you know, the Tax Cuts and Jobs Act reduced the individual tax rates. So the highest tax rate became 37%. Those tax rates were set to expire in 2026. Those are now made permanent in the law. So those tax rates will continue forward until the law is changed. Another example on the business side would be bonus depreciation. So for a number of years, we had 100% bonus depreciation. So in the year that you purchase a fixed asset, you can take a deduction for the full cost. Well, as part of the Tax Cuts and Jobs Act, that was sunsetting over a period of years, and that percentage was stepping down 20% every year until it was gone. And we had already gotten down to, I think this year we were at, I want to say the 40% mark for 2025. Well, what this bill does is take it back up to 100% and make that permanent going forward. So there are a number of provisions that are just being made permanent that were in the law in the past. And in some instances, we've had for even decades. But they always expired every couple of years, and Congress would have to negotiate and try and come up with some method of getting those extended or adding a few more years to it. So it's nice that a lot of these provisions are now being made permanent in the law.
What are some of those areas that are completely new with this bill?
So one of the biggest changes that came out of this bill, because a lot of what it does, like I said, is either just extends or makes permanent old provisions, or it fixes things that had expired in the last couple of years. So like, to give you an example of that, you know, in the past, research and development, you were able to deduct the expenses related to research and development while also taking a tax credit related to those expenses. A few years ago, the law changed wherein you could still take the credit, but you could not deduct the expenses in the year they were incurred. You had to capitalize them and amortize them, basically deduct them over a number of years instead of deduct them in the year they were incurred. And so one of the things this bill does is fix that issue and allow you to go back to fully deducting those expenses in the year they're incurred. On the individual side, you know, we have what they're now calling these Trump accounts. It's basically almost like an IRA, a retirement account for minors. And what it allows you to do is put money into these accounts for anybody that's under 18. And then at age 18, they can actually start taking the money out. Part of the idea here is to help them kind of get a start in life.
Great. So there are some new features and some that we were used to at one point in time that went away, have now resurfaced. This, of course, was a bill that was being worked on essentially since Trump first took office in January. And there was a lot of backtracking between the House, between the Senate, or between the executive branch there. What were some of those areas that really had a lot of friction there that extended the timetable before approval was ultimately reached?
Yeah, that's a great question. So a lot of these provisions they've been talking about even since before Trump was elected, even before Election Day. So last year, there were bills moving through Congress trying to fix some of these issues we've talked about, things that were expired or already expired from the Tax Cuts and Jobs Act. There was this big looming deadline, so to speak, that at the end of 2025, a lot of those provisions were either going to be gone or were in the process of phasing out, and people were going to see a lot bigger tax hit. And it became this big problem that Congress has been looking at for a while. The problem that they ran into is getting everybody to agree on how to fix all of those provisions, especially within the rules within the Senate and the rules that they have to follow in order to pass a tax bill like this. And so what they've been negotiating about over the last year or more are some of the specific provisions. So to give you an example of that, under the Tax Cuts and Jobs Act, for individuals itemizing their deductions, they were allowed to take a $10,000 state and local tax deduction. So your income taxes, your property taxes, things like that you pay the state and local governments, that deduction was limited to $10,000. Well, that was a huge issue for a number of states that have higher tax rates. So California, Illinois, New York, that created a lot of problems for those constituents. So the congressmen and women and the senators from those states, that was a huge issue for them. They wanted to make sure that cap either got eliminated or got raised. Well, part of the problem is you've got to figure out, hey, if we're gonna decrease taxes somewhere, you got to have some way to pay for that. So somebody else has to pay a tax somewhere. So a lot of what they've been negotiating about over the last year is, hey, in my state, we're hit specifically by these provisions that are being addressed. And we want these changes to those provisions. And that's going to cause us to impact other states. Well, those states don't want those changes to have to pay for these states to have lower taxes. So now you've got to negotiate. How do you come up with a way of paying for those tax cuts for those states that are negatively impacted by some of these provisions? And so there's been a lot of negotiation. And with the new Congress, there's such a narrow margin of Republican control in the House and the Senate. And there are people that are Republicans from those states that have those issues. So they were really kind of holding out to how are we going to fix those particular provisions. And then you've got the Democrats coming along and talking about things like, they want to increase the child tax credit and all these various other provisions. And so it really kind of came down to there were so many things being changed. There was just a lot of negotiation that had to take place between all the different members of Congress, the House of Representatives, and of the Senate, and that the president was willing to agree to. So luckily, over the last couple of months, they've really pushed hard, come to some agreements. So for example, the child tax credit did get an increase. That state and local tax cap did get increased. But some of the other provisions, such as some of the clean vehicle credits, those got eliminated. It's one of the ways they're paying for some of these provisions. So there are winners and losers in all of this, and it was just a matter of finding the right mix that you could get enough people to vote for it.
Very good points there. It sounds like a lot of the provisions then that had produced those sticky points were more so on the individual standpoint. Thinking of the provisions, though, which ones should the small and mid-sized businesses really be aware of?
Yeah, so I've kind of already mentioned the research and development expenses, being able to deduct those right away while still being able to take the credit. That's huge for small to medium-sized businesses because you get kind of a double tax benefit for doing that research and development, coming up with these new products, these new processes, and really being innovative and helping the economy, helping technology. So those are huge for small to medium-sized businesses that are especially developing some new product. And in addition to that, I would say, the extension of the 100% bonus depreciation, that's huge because it allows you to deduct those expenses right away, especially for a small startup business that are spending a lot on those fixed assets at the beginning of their business cycle. They can really take advantage of those tax benefits, save some money, and use that money to help build and grow that business. Kind of related to bonus depreciation is Section 179. So that is a provision that allows you to elect expenses related to fixed assets. And that essentially doubled the amount that you're able to elect in a given year. So in certain circumstances, you can't take bonus depreciation, but you can still make the 179 election and still get that deduction. And by increasing the amount that you can elect for that deduction, now you're allowing the small to medium-sized businesses, if you can't take bonus, hey, you can at least maybe elect 179. Now, 179 will create a loss. It can't make you go below zero for taxable income, but at least it can get you to zero.
So thinking from your role as a CPA, for the rest of the year or even going into next year, how should small or mid-sized businesses be impacting or changing their strategy?
So I think because there are so many changes here, I think I kind of mentioned earlier, this bill is 870 pages. The summary is 56 pages. There are probably hundreds of changes within this tax bill, all of which kind of impact each other. There are phase outs, so we could talk about the increase to the child tax credit, but who gets to take that? We can talk about tips or tax-free, but who gets to take that? Because it depends on your level of income. So what I would tell you is all of these things kind of interplay together and really impact what your net tax number is. So what I would say is, because there are so many changes, it's hard to look at any one change in isolation. What I would recommend doing is a multi-year projection. So starting with what you think book income is going to be this year, and then using very sophisticated analysis in order to look at what are the tax implications of all of these changes. And then, okay, what are some of these changes that you want to maybe implement? So there are changes to the rules about employers paying off student loans for their employees. There are changes related to various benefits for employees, child care paid for by their employer, those types of things. So in addition to just looking at, hey, if we just keep doing what we're doing, what's the tax impact going to be as a result of all of these changes interacting together? But also, what came out of this bill that we might want to take advantage of? You know, what are some of those benefits that we get a deduction or a tax credit for? Any energy credits that are still available? What are the deadlines for some of these changes? So is there something we can do? Some of these changes go into effect September 30th. Some of them go into effect January 1st. Is there anything we can do before these deadlines come into play? And really take a full comprehensive look at the total impact of all of these changes and see what can we do before September 30th, before December 31st? What do we want to do next year? Like I said, do that multi-year projection and see how is this going to impact us from a tax projection standpoint, a tax implication, but then how do we want to also implement anything that came out of this bill that we might be able to benefit from.
Thank you all for listening. I'm Matt Staninger, and be sure to tune in the next time when we sit down with more industry leaders to bring insights to the topics you want to hear about. Thank you.